Jerome Powell just admitted the jobs numbers might be massively wrong. The Fed just fired the starting gun on rate cuts. And at the same time, investors are asking if this is the moment the AI bubble quietly starts leaking air. If you get this next 12 to 24 months wrong, you don't just miss some gains, you could nuke your portfolio for an entire decade. Welcome back to The Comment Section with Thomas Paul, where we look at the economy, realize it's being driven by vibes and spreadsheets, and then try to survive it anyway. Today we're breaking down two absolutely crucial things: what the Fed and Jerome Powell just told us without saying it out loud, and why some people are calling what's coming a once-in-a-lifetime event for investors. And then we'll put it all together into a clear game plan for what to watch and how to think about your money. Let's get into it. So, here's what just happened with Jerome Powell, and why Finance YouTube basically lit on fire. The Fed just cut rates. The economy on paper still looks strong. Inflation is off the peak, but not exactly dead and buried. And Powell walks out and basically says, yeah, we're more open to turning the money printer back on again if we have to. In more polite Fed speak, he hinted they're now more philosophically open to quantitative easing compared to the last few years of quantitative tightening, where they were pulling tens of billions of dollars out of the system every month. Translation into non-nerd English. They went from, we're slamming on the brakes, to, okay, we've got our foot hovering over the gas again, just in case. And here's where things get interesting. The Fed didn't cut because GDP looks bad. They didn't cut because unemployment officially looks bad. The headline numbers still say, hey, everything's fine, keep buying Nvidia. But Powell basically called out the Bureau of Labor Statistics, nicely, by saying they think the job numbers are overstated by something like 60,000 jobs per month. Let that sink in. He's saying, the reports we've all been staring at might be off, by the size of a mid-sized American city, every single month. And that's the justification for the 25 basis point cut. So publicly, the narrative is, we're just fine-tuning, soft landing, we're threading the needle. But under the surface, what he's really signaling is, we think the labor market is a lot weaker than it looks, and we'd rather cut early than watch this thing crash in real time. Oh, and it wasn't even unanimous. The vote was 9-3. 2 people wanted no cut at all. 1 person wanted a bigger cut, 50 basis points. So even inside the Fed, they don't agree on how urgent this situation is. The doves are looking at the job market like, this is already cracking, hit the gas. The hawks are looking at inflation and saying, are you insane? Don't you dare. And Powell? He leaned dovish, very dovish. He basically said, we're more focused on employment now than on squeezing the last bit of inflation out. That's a huge shift. Because remember, for the last couple of years, it's been all about, we will keep at it until inflation is down to 2%, no ifs, ands, or buts. Now the tune is changing to, yeah, about that. We also don't want a recession with mass layoffs, so we're willing to ease earlier. But wait, it gets even wilder. If the Fed is this worried about the job market while the official numbers still look fine, what does that tell you about what's going on behind the scenes in the real economy? Companies quietly freezing hiring, layoffs just under the surface, small businesses feeling the pinch from higher rates, consumers burning through savings and living on plastic again. The Fed sees all that data we don't see in real time. So if they're flinching now, something's up. So, what are the key takeaways from this holy crap Jerome Powell moment? First, the Fed just admitted reality doesn't match the headline data. They think job growth is way lower than what the monthly reports say. If they're right, that means the labor market is weaker, wage growth isn't as strong as advertised, and the economy is more fragile than the official narrative. Second, the shift from tightening to easing is not just about inflation being lower, it's about fear. Fear that if they don't start cutting now, they'll trigger a hard landing. Rising unemployment, falling corporate earnings, asset prices rolling over. In other words, they're trying to avoid being the bad guy in the next recession. Third, they just quietly reloaded the bazooka. By saying they're more open to quantitative easing again, they're telling you, if things get ugly, yes, we will go back to pumping money into the system. And we all know what that does. It pushes up asset prices, stocks, real estate, risk assets. So in one press conference, they basically said, "We're scared enough to cut now. We're not convinced the labor market data is right. And if this spirals, we will absolutely go full money printer mode again." Because nothing says long-term stability like a central bank trying to manage a trillion-dollar economy with lagging spreadsheets and vibes. Now, here's the crucial part. Markets love lower rates until they realize why rates are going lower. If investors decide, "Oh cool, soft landing, gentle cuts, earnings will be fine," the market just keeps grinding up. But if they wake up one day and say, "Wait, they're cutting this fast because we're actually heading for a real slowdown," that's when panic shows up. So the million-dollar question is, which one is it? And that brings us to the other half of today's story, the once-in-a-lifetime warning. Let's shift gears to this idea of a once-in-a-lifetime event for investors. The big theme here, everyone's looking at the AI boom and asking, is this 1999.com mania 2.0? Or is this 1995 early internet, where we're still in the first innings and the bubble talk is way too early? Right now, markets are still in a bullish cycle. Despite all the doom posts on X and the crash thumbnails on YouTube, we are not in a full-blown meltdown. Yet. NASDAQ is up big over the past few years. Mega-cap tech is still sucking in capital like a black hole. AI infrastructure spending is in hypergrowth. Data centers, chips, software, cloud. And here's the twist. This is exactly when you're supposed to prepare for a correction or even a crash. Not when CNBC is doing markets in turmoil specials every night. Not when everyone in your group chat suddenly becomes a macro expert because their portfolio is down 30%. By then, it's too late. You're in reaction mode, not preparation mode. Right now, when things still look pretty good, is the time to decide how you want to play the next big move. And here's where things get spicy. We've got this combination, a Fed that's getting ready to ease again, an AI-driven bull cycle that's pushed valuations into nosebleed territory for some names, and a real economy that might be way weaker than the official numbers suggest. That cocktail? That's your once-in-a-lifetime setup, because you don't often get a major technological shift like AI, at the same time as a huge monetary policy pivot, at the same time as a massive valuation divergence between the AI darlings and literally everything else. You won't believe how powerful that combination can be, for good or for bad, depending on how you position yourself. On the one hand, if AI really is the next internet, the next smartphone, the next cloud computing wave, then the companies building the infrastructure and key platforms could keep compounding for a decade. On the other hand, markets always overshoot. The narrative gets ahead of the numbers. Stocks start pricing in perfection, and the first time growth slows even a little bit, valuations compress hard. That doesn't mean AI is fake. It means the price you paid was stupid. So the once-in-a-lifetime part isn't, "Oh no, crash incoming, hide under your mattress." It's, you might get one shot in your investing lifetime to buy world-changing tech leaders at rational prices, after the first brutal shakeout. But you need to be sane before the chaos, not during it. Let's tie these two things together. Jerome Powell turning dovish and the AI mania. Ask yourself, why is everyone suddenly asking, is this the top, when it comes to AI? Because cracks are starting to show. Some high-flying names are missing expectations. Growth is still good, but not justify 100 times earnings forever good. Spending cycles are lumpy. Corporate budgets aren't infinite. Meanwhile, the Fed is signaling we might need to support growth soon. So we're in this dangerous in-between phase. Macro is sending mixed signals. Micro is sending mixed signals. Sentiment is starting to wobble, but the indices are still high. And this is exactly when investors do the dumbest stuff. They FOMO buy the last leg of the bubble because it's never going down. Or they panic sell everything too early, sit in cash, and then watch inflation eat it while the market rips without them for another year or two. So what do smart investors do instead? They accept two uncomfortable truths at the same time. Yes, AI is real and big and transformative. Yes, some AI-related stocks are wildly overpriced and will get wrecked in a real correction. They also realize, yes, the Fed's shift to cutting and possible QE 2.0 will eventually support asset prices again. But no, that doesn't mean you won't see painful volatility and sharp drawdowns in the meantime. You can have both, a long-term structural bull story and a brutal gut-check correction within that story. Look at the dot-com era. Internet was real, Amazon was real, but plenty of internet stocks went to zero, and even the winners got crushed 80 to 90% before they recovered. So the once-in-a-lifetime window is about surviving the storm, so you're still standing when assets go on sale. All right, let's talk about what this all means for you as an investor, and what you should be watching next. First, you need to understand where we are in the cycle. We are not in full-blown crisis mode. We also are not in the everything is cheap, buy indiscriminately phase. We're in a late-stage bull environment with increasing macro stress and a central bank pivot. That means volatility is likely to rise, narratives will change fast, and liquidity, thanks to rate cuts and potential easing, might create some very weird price action. So what do you watch? Number 1. The labor market data revisions. If the Fed is right and the job numbers are overstated by tens of thousands per month, at some point, those revisions will come through. You want to watch. Are future jobs reports getting revised down? Is unemployment quietly ticking up while everyone's still pretending it's strong? Are job openings and quits rolling over? Once the narrative shifts from strong employment, soft landing, to layoffs are picking up, markets will start repricing risk. Number 2. Earnings from the AI and mega-cap tech names. Forget the story. Watch the numbers. Are revenue and earnings still growing fast enough to justify current valuations? Are companies guiding higher or starting to guide more cautiously? Do they start talking about optimization, efficiency, and slower enterprise spending? Those are early signs that the hypergrowth phase might be cooling. If the AI narrative runs into even a couple of big earnings disappointments while the Fed is in mid-pivot, that's prime crash bait. Number 3. Credit and liquidity conditions. Fancy way of saying, can people still borrow cheaply and is money still flowing? Are credit spreads widening? Are junk bonds selling off? Are banks tightening lending standards? If credit starts freezing up while earnings wobble, that's when corrections turn into crashes. But here's the twist. This is not just a doom story. Because at the same time, the Fed has basically pre-announced, we will support the system if it breaks badly enough. They might cut more, they might slow down or reverse quantitative tightening, they might even go all in on QE again. That creates phases. Phase 1, shock and sell-off when people realize growth is slowing and bubbles are deflating. Phase 2, the Fed panics, eases aggressively, and assets eventually bottom. Phase 3, the survivors of the crash, especially in real industries like AI, cloud, energy transition, critical infrastructure, go on multi-year runs. Your job is not to predict the exact day of the top or bottom. Your job is to avoid being the last idiot buying the most overhyped names at the peak. Stay liquid and diversified enough to take advantage of lower prices. And know what businesses you actually want to own for 5 to 10 years when they finally get cheap enough. So what does that look like practically? Let's talk principles, not specific stock tips. 1. Don't go all in or all out. If your strategy is sell everything, crash is coming, or YOLO, this time is different, AI will only go up. Congratulations, you've joined the emotional roller coaster investing club. A more rational approach. Trim exposure to your highest risk, most speculative names that depend on perfect conditions. Rebalance into quality. Cash-generating companies with real moats, strong balance sheets, and realistic valuations. Keep some dry powder, actual cash or low-risk assets that you can deploy during big drawdowns. 2. Separate story stocks from businesses. Right now, Anything with AI slapped on the slide deck gets attention. But when the music stops, markets suddenly remember, oh right, cash flow matters. You want to be asking, if rates stay higher than zero for years, can this company survive? If growth slows from 40% to 15%, does the valuation still make sense? Is this business actually needed in an AI world, or is it simply riding the hype? 3. Plan for a correction while things still feel okay. You don't wait for the crash to start thinking about what you would buy at 20, 30, 50% off. You make that list now. Ask yourself, if Amazon, Microsoft, Nvidia, or your favorite high-quality name dropped 30%, would you panic sell, or would you be excited to buy more? If your answer is panic, you're overexposed. If your answer is buy more, but you have no cash, you're unprepared. 4. Ignore short-term noise, but not long-term signals. Yes, there will be a million scary headlines. Yes, there will be days when markets are red and everyone's yelling, "This is it." Zoom out. Is the Fed tightening or easing? Is corporate profitability healthy or being crushed? Is the innovation cycle, like AI, in early expansion or late-stage exhaustion? Right now, the Fed is pivoting to easing. Corporate profits are under some pressure, but not in full collapse. The AI wave is real, but maybe ahead of itself in certain stocks. That is not end of the world. That is transition phase, which is exactly why it feels so confusing. So, what should you do next, as in literally after this video? 1. Audit your portfolio. Look at every position and ask, if this dropped 40% tomorrow, would I hold, buy more, or regret I ever touched it? If the answer is regret, ask yourself why you own it. 2. Think in scenarios, not predictions. Scenario A: soft landing, mild slowdown, Fed eases, AI growth continues, valuations stay high or even drift higher. In that world, trimming extreme risk now might underperform a bit, but you still participate in upside. Scenario B: hard landing, earnings recession, AI valuations get clobbered, indices correct 20 to 40%, the Fed has to go full rescue mode. In that world, having cash and quality beats YOLO momentum every time. You want a setup where you can live with both outcomes. You're not wiped out if we get scenario B. You're not totally sidelined if we get scenario A. 3. Watch Powell and the Fed communication like a hawk. If they start soundtracking their meetings with phrases like deteriorating labor market, unexpected tightening in financial conditions, more significant slowdown than anticipated, that's your cue that we're moving deeper into risk-off. If, on the other hand, they start taking victory laps like inflation trends are favorable, labor market is cooling but stable, soft landing remains our base case, that likely keeps the risk-on party going a bit longer but also inflates the eventual hangover. Let's bring this home. We've got a Fed that just admitted the labor market might be a lot weaker than the official numbers say. A clear shift from crush inflation at any cost to protect employment even if inflation isn't fully dead. An AI-driven bull market that may be in the euphoric late stage for some names, but absolutely not done as a long-term structural theme. Put it together, and you get a setup that truly might be once in a generation, a policy pivot, a tech revolution, a market that's starting to wobble but hasn't cracked yet. You can treat that as a reason to panic, or a reason to finally take this seriously and build a plan. Because here's the truth. Most people will only realize the importance of this moment in hindsight. They'll say, man, 2024, 2025, that was the window. I either made life-changing moves then, or I blew it. You don't have to be that person. Use this time, while indices are still up, while AI stocks are still beloved, while Jerome Powell is just gently hinting at worry instead of screaming it, to clean up your portfolio, upgrade your holdings, and get mentally ready for the kind of volatility that actually creates opportunity. Now, I want to hear from you. Do you think we're at the beginning of the AI bubble popping? Or is this just another little wobble before a much bigger melt-up fueled by rate cuts and QE? Drop your hottest, spiciest, most unfiltered takedown in the comments. I read them, I argue with them in my head, and sometimes I even steal them for future episodes. If you got value out of this breakdown, hit that like button so YouTube knows we're not completely insane for making long videos about central bankers and AI chips. And if you want more deep dives on the chaos at the intersection of money, politics, and technology, make sure you subscribe to The Comment Section with Thomas Paul and turn on notifications so you don't miss the next time Jerome Powell does something interesting. Thanks for hanging out, stay rational, stay skeptical, and I'll see you in the next episode.